Why is Warren Buffett going all out into this stock? Warren Buffett's Berkshire Hathaway now owns 32% of SiriusXM. What does Warren Buffett see that we don't? SiriusXM is currently trading for about $27 a share. Depending on when you watch this video, it could be lower or a little higher, and their 52-week low price was $22 a share. So can we just say, for argument's sakes, they are near their 52-week low, and year to date, they are down by negative 49%. So today, we're going to go ahead and look at SiriusXM, ticker symbol SIRI. No, we're not talking about Apple's little side chick, but it's SIRI, referring to SiriusXM. And we're going to determine whether or not it's a dividend compounder or a disgusting dividend company. And in order to do that, we're going to be looking at the intangibles, the finances, and run some valuation models. And the thing is, other YouTube channels only look at the finances, which is fine. It's okay. And the metrics and the ratios. But in my personal opinion, I think the whole story surrounding a company is just as important because it's the story that drives the numbers. What are their growth prospects, their catalysts, what's going in their favor, what's not going in their favor. So if you agree with me, go ahead and subscribe to this YouTube channel because that's how we do things. We don't only just look at the numbers, we also look at the intangibles. So we're going to learn so much about this company that I promise you're going to annoy your wife at the dinner table with all of the facts that you learned about SiriusXM. I promise you're going to walk away from this video learning more than you need to know about SiriusXM. Now, before we go any further, remember, Warren Buffett is the kind of guy that believes to the core of his nipples value investing and being greedy when others are fearful. So did you know during the financial crisis of 2008-2009, Warren Buffett invested $5 billion into Goldman Sachs? Reason being is that he bet for a rebound for them to bounce up from their 52-week low. Consequently, he walked away with a $3.7 billion profit. And I point this out because at the time, banking stocks were crushed and nobody wanted to touch them for good reason because they were corrupt, they were in a scandal, and Lehman Brothers went bankrupt. So banking stocks was like the undesirable industry sector in stocks at the time. But Warren Buffett saw opportunity in what other people thought was ugly, just like your wife. He does not like exciting or trendy companies that he does not understand. On the other hand, Warren Buffett likes boring, but well-managed businesses. Then again, he's the same kind of guy who made a terrible investment into Paramount 2 years ago, and he sold at a loss. And I call that out to show that we're all human. We all make mistakes. So as you watch this video, it's up to you to determine whether or not SiriusXM is going to be like the Goldman Sachs investment that he made, or the mistake that he made with Paramount. Now, what you see on your screen right now is the Berkshire Hathaway Warren Buffett portfolio. And right here is SiriusXM. He currently has about 105 million shares, and his average purchase price is $23.65 a share, which means that he holds about $2.4 billion of SiriusXM stock. And since he purchased this and put it into the portfolio, it has gone up by 17%. To put this into perspective, right now, there's currently about 339 million shares outstanding for SiriusXM. And as you can see, Warren Buffett owns about 105 million. That means at the time of this video and recording, Berkshire Hathaway owns about a third of the shares that are outstanding. And even though Warren Buffett has $2.4 billion of SiriusXM, it only makes up 0.9% of his portfolio allocation. So what I think is happening right now is that Warren Buffett wants to own this company outright, and he wants to put it into the Berkshire Hathaway portfolio of companies. Because if you didn't know, Berkshire Hathaway is a conglomerate. It has a whole umbrella of different businesses and companies operating under its name, like Geico Car Insurance, Brooks Running Shoes, which in my opinion is top 3 running shoe brands out there. Maybe in the near future, SiriusXM. So I wouldn't be surprised if he ends up buying more as a Christmas gift to himself, and by the end of the year, he's going to own, 40 to 50% of the company. Now remember, this is the same type of guy who eats McDonald's every single day and drinks Coca-Cola like it's his oxygen source. And he's 94 years old, and since he's a billionaire, there. If he needs to replace his heart, he can just replace that heart. So I can see why he doesn't really care about dietary and nutritional needs. But something else that he's consistent at is he likes to buy great companies at a fair price rather than fair companies at a great price. So he thinks SiriusXM is severely undervalued, especially if he's willing to scoop up this many shares. He's doubling down and acquiring more and more. So the first metric that we're going to be taking a look at is their dividend profile. And when we look at their dividend yield right now, it's just shy of 4% at 3.9%, meaning for every share of SIRI stock that you own, you get paid $1.08 in dividends, which is not too bad, right? A 4% dividend yield. But as we look over here, this is kind of a red flag on surface level, right? To have a negative 16% dividend payout ratio, because that means that the dividend is not sustainable. However, it's because their accounting is all wonky right now, and we'll talk more about that when we discuss their Q3 earnings, which they did very recently. They've been growing the dividend for the past 8 years, and they grow this dividend payout on average by 16.5% year over year. When we look at their dividend history, it is just a beautiful picture to see. They are committed to paying out that dividend and growing out that dividend. And the best part is, during the pandemic, a lot of companies were freezing or even cutting their dividends, but it looks like SiriusXM still paid that dividend and even grew it in Q4 of 2020. And next up, we're going to be taking a look at their shares outstanding. Basically, you want to see a company buying back the shares instead of issuing more shares and diluting the shareholders. And when it comes to SiriusXM, this is exactly what you want to see. So I don't know, let's back it up right here. Back in 2010, there was about 637 million shares outstanding. And they did issue a little bit of more shares up until the beginning of 2012. And since then, they've just been on a very consistent record of buying back those shares quarter after quarter, year after year. And it looks like as of today, there's 339 million shares. And between you and me, there's no signs of them slowing down on purchasing back these shares, especially if it keeps trading at a low valuation and at a 52-week low. And the next metric that we're going to be looking at is their revenue. Is the company growing their top line year over year? And it does appear to be the case, but when we look at the most recent years, it looks like in 2023, they topped out at about $9 billion, and now they're slowly going down in a decline. As we can see by the bottom graph, the third one that's on your screen, it went down by negative 3.2% year over year, quarter to quarter, and then it went down by another negative 4.4% year over year, quarter to quarter. And we'll talk more about that here in a little bit. But as we scroll down and look at their revenue in a numerical display year over year, 2009, they posted $2.4 billion. And since then, it's just been going up. However, it does look like they are trending back down. So what's going on? And the next metric is going to be the free cash flow. In a perfect world, you want to see a company that is growing their free cash flow year over year, or at least in a positive trend. And if you can't do that, you at least want to see the free cash flow in a very consistent and stable manner. So as we scroll down and take a look at their free cash flow, this is a very cash-heavy business. Take a look at this. In 2016, they posted $1.5 billion of free cash flow. And as we fast forward, it just appears to be that way, right? $1.6 billion here. However, in the past 3 years or so, the free cash flow has been going down. $1.2 billion is still pretty good. But when we look at it from a bird's eye view, this is still a very beautiful picture to see. However, if this free cash flow does decrease to like $900 million and then $600 million, that's not what we want to see. But if they're able to stabilize at around that $1.2 to $1.5 billion mark, then that shows the company is superior in their cash management strategy. So now let's go ahead and talk about their business model. How exactly do they make revenue? As you can see on the screen right now, their two business products are number one, SiriusXM, and number two, Pandora. Think of SiriusXM as satellite radio with curated music playlists, DJs that are managing those playlists in a live format. There's music channels like the techno channel, EDM channel, jazz channel, classical, and the usual talk shows that people tend to listen to. And then there's also Pandora. It's the music streaming service arm of their business that does not utilize satellites. Pandora uses AI to play songs that you would like and in a fantastic way to discover new hidden gems. If you just tell them what song or artist that you're into, they can curate 100, 200, 400 songs to play in a row that sound like it or have similar vibes, energy, or atmosphere. And Pandora currently has about 50 million active users, whereas SiriusXM has about 34 million paying customers as subscribers. So when you think about it, SiriusXM has about 10% of the US population as paying customers. And unfortunately, here's the transparency. Once I started digging into this company, that subscriber count has been flat since 2017. And the crazy thing is, in the same time period, Spotify, which is their competitor, they have added more than 40 million North American subscribers in the exact same time period. And as you can see on your screen right now by the pie graph, one of my MBA professors absolutely despise pie graphs, but to me, I don't really have a problem with it. SiriusXM, depicted by the blue, makes up about 76% of the company's total revenue, and they make up about 85% of the gross profit. Pandora, surprisingly, does not perform that well. They only make up about 24% of the revenue. And speaking of Pandora, their subscriber base is exclusively in the US. And the sad thing is, it's also been flat since the beginning of 2018. And some more unfortunate news, it's only about 6% of the size of Spotify's North American subscriber base. So Spotify just demolishes SiriusXM when you look at it apple to apple. So what we can take away from the facts and the data is that SiriusXM is not exactly growing the amount of subscribers that they have. It's more so about keeping the existing customer base from canceling. And I heard that if you try to cancel, it is a very annoying process. But then again, like almost every single business and company makes it a pain point and a sore and a nuisance to cancel. Like, have you ever tried canceling your gym membership? Dude, it is one of the worst experiences that I wouldn't wish upon my worst enemies. And maybe the strategy is SiriusXM makes it a difficult process to cancel so that you just say, oh, I'll just keep my subscription. You know, that's the harsh reality. I mean, yes, they're adding customers every quarter. I think they add like 10 to 20,000 paying customers every quarter. But the fact of the matter is, they're losing more than they're adding. So it's kind of like a declining population rate in South Korea, Japan, or in the Scandinavian countries. There's more people dying than there are babies being born. So unless things change, that's how it is with SiriusXM. So let's go ahead and dive a little deeper and look into this company. So they generate revenue, as you can see on your screen right now, from two modalities. Number one is revenue from the subscription fees for SiriusXM or Pandora. And then number two, they get payment from companies trying to advertise on their platforms. They generated about $2 billion from advertisers and about $7 billion in revenue from subscription fees. And the thing is, almost every business out there is transitioning from one-time membership payments to reoccurring monthly subscription fees, because when you think about it on paper and in an accounting perspective, that income is predictable, stable, reliable cash flow, which is why Spotify, Costco, Amazon Prime, Adobe, and almost every company out there is embracing this tactic. Because when you only do a one-off payment, that leads to cycles, right? Sometimes you get more, and sometimes you don't get more. So to avoid those fluctuations, by doing a subscription payment every quarter or every month, you can generate cash in a more consistent manner. And those paid advertisements are usually played in their free version of Pandora. So you'll usually have about like a streak of 3 to 5 songs in a row, and then all of a sudden a random ad pops up like, hey, do you need a bra for your man boobs? All that to say, even though Pandora doesn't exactly have a lot of paying members, they make up for it through the advertisers paying for those ads. So who is their customer base? Their target demographic usually involves older taxi drivers that are in their car for like 12 to 16 hours a day, traditional truck drivers, and people who lease or purchase a new car every single year. The reason being is that their business model relies on free trials from people using the service while driving to see how good it is, and then for their pitch to do the work for them, because now they can't imagine driving their car without SiriusXM, because it made their driving driving experience just that much better. Because as you drive to work at that job that you absolutely despise and hate, you can listen to SiriusXM's NFL radio. From when you go to point A to point B, it just makes your life a little bit better, and that's always been their pitch. And come to find out, when you think about their customer satisfaction rates against the competition, it's pretty awesome to see. When surveyed with customers across the board, the SiriusXM customers are the most pound for pound satisfied. Although if we're going to be honest, Spotify is right there with them, tied at 8.7 to an 8.7. And apparently they lead the way in time spent listening with 21%, and YouTube being 15% and Spotify being 20% as well. And when you consider the finances and metrics surrounding SiriusXM and their customer base, it's really superior. So what you see on the left side of your screen, $6.3 billion of revenue generated through SiriusXM. The ARPU is the average revenue per user. So with SiriusXM, each paying customer, they generate about $15.24 in reoccurring revenue every single month because they operate on a subscription model. Netflix does not surprise me as number one at $17 per user. And at the bottom of the average revenue per user is Spotify at $5 per paying customer. So SiriusXM right there, that is spectacular. And then when we look at the bar graphs in the middle of your screen, the churn is basically what we talked about earlier. The retention rates of people leaving your business or service. But anyways, all that to say, SiriusXM loses about 1.5% of their customer base quarter to quarter, year over year. And on the other side of that spectrum, you have Max, I think that's HBO, they lose about 6.5% of their paying customers. But here's where the story gets really interesting, because when you think about the gross margin, SiriusXM just takes a hot steaming dump over the competition at 60% operational efficiency. Spotify is at a 29% gross profit. So when you think about it in the lens of operational efficiency in comparison with the other streaming competitors and companies out there, SiriusXM looks pretty darn good on paper. So after hearing all of that, you might be confused and wondering, why is their stock price getting absolutely destroyed over the long run? A slow and painful death. Case in point, in the past 5 years, the stock is down by 59%. And that's because their revenue, subscriber base, and revenue per customer are all declining in recent times. So consequently, Wall Street thinks of SiriusXM as a dying business. They just don't like them. And because their stock price has been in the red and in the decline for so long, well, not too long ago, September 9th, they did a 10-for-1 reverse stock split. Meaning, for every 10 shares of SiriusXM that you had, they combined those 10 to turn it into one share. Basically, all that to say, you hate to see it. But they had to do it because their stock was on the verge of being delisted because it didn't meet the exchange requirements. To stay on the stock exchange, you have to not be a penny stock. And essentially, SiriusXM was hovering and bordering and flirting with the territory of being a penny stock. So when SiriusXM proposed and executed on that plan, it artificially boosted the stock price. So right before the reverse stock split, let's just go ahead and say that SiriusXM traded for $3 a share. Immediately afterwards, then you would have had $30 per share for SIRI stock because you would have 10 times the 3 equals 30. Wow. Well, I just learned some math. So the fact of the matter is, this stock is just going downhill. Wall Street does not like it. However, we need to think like Warren Buffett and try to see it from his point of view, because he's purchasing the stock as other people are running away from it. So what does Warren Buffett see? Do you remember that question I asked at the beginning of the video? And maybe that's because he thinks perhaps the declining subscriber story is bottoming out. Of course, in the recent years, we saw that it's declining year over year, quarter after quarter. Everyone's panicking, but maybe the worst has passed for now. And I don't blame Wall Street, because if you hear about a company losing their customers quarter after quarter, year after year, of course you're going to be pretty bearish on the company. And as a potential investor, yeah, that sounds pretty devastating. But the bigger question here is, if you haven't canceled your SiriusXM or Pandora subscription by now, then when will you? All that to say, I think the ones that continue to pay are probably life customers. I think they're very sticky because unlike Spotify, YouTube Music, and everything, I think SiriusXM has had a relationship with most of their customers since like 2005, 2006, 2007. We're talking about an older demographic and generation of Americans. And now, yes, they're pivoting into transitioning and trying to acquire the younger demographic. But for the most part, I would argue that they are targeting very aggressively people that are over the age of 40 and on the road more than half of their working life. So when people want to fear and doom and propose the idea that the entire paying fan base of SiriusXM is just going to jump ship and everyone's going to unsubscribe all at once, when I hear that, dude, that's a fat chance. It's like a white guy playing cornerback in football. It's just not going to happen. As you can see on your screen right now, their core audience, the demographic that they're shooting for, is Gen X and older, meaning people that are driving or on the road more often than not because of their work. And it says they addressed about 60% of the total addressable market, and they have high satisfaction, as we saw earlier, with an 8.7 out of 10, and a very low churn rate of about 1.5%. And they are trying to target the younger Gen Z, the millennials, and they label them as the growth audience, their catalyst, and they say they've penetrated about 10% of the total addressable market. But what's holding them back is the limited experience with SiriusXM. Not many people actually know about SiriusXM. Case in point, if you're from Germany, the Netherlands, China, Korea, wherever you are listening to this and you're not from the US, you've probably never have heard of SiriusXM or Pandora, right? All that to say, I think it's a really perfect transition to segue into talking about their rivals and competitors. So who are they? It's the other music streaming services, and the catch is, they don't rely on satellites like SiriusXM does. The competitors only require an internet connection, and the marketing isn't based around cars and driving. So it's everyone that's involved in the music streaming business, like Spotify, YouTube Music, Apple Music, Amazon Music, all of those people. And the thing is, I would argue their competition also does not have an economic moat. But here's a cool history fact about SiriusXM. In the past, they had a huge economic moat in being able to provide uninterrupted music to consumers that are on the road. However, these days, almost everyone can just hook up their phones to the car's Bluetooth or center console and get the exact same effect. So SiriusXM, in my opinion, I think that moat is dissolving away. And I'm old enough to remember, like 20 years ago, they were saying like Sirius and XM were changing the name of the game. They actually merged a while ago, so they had two separate entities. But traditional radio stations were just pooping their pants because they were worried about what was going to happen. Sure enough, SiriusXM ended up taking away a lot of the market share from people that used to listen to the radio stations in their car. Because when you drive out of the radius, you would get static. And with traditional radio stations, there was just way too much commercial breaks, advertisements, and censorship. Whereas with satellite radio, it was a whole different ballgame. But I sound super old right now because that was like 20 years ago. At this point, Spotify, Apple Music, and everyone else has caught up. So that's the rivals and competitors. I wanted to formally address that. And as you can see on your screen right now, this is their strategy with content in order to reach new customers. So with the core demographic of people being like my age, 40, 50, 60, 70 years old, they know exactly what they like. And with the younger kids, they know exactly what they like as well. And up to this point, if you are a rational person, you're probably weighing the pros and the cons, and you might conclude that, dude, this company sucks. However, before you reach that conclusion, check this out. So for the longest time, right, they committed to the idea of in-vehicle music, because that's all I talked about. Right? Their strategy, pitch, and business model was people being in their cars and providing that music or listening experience as they drive. However, this is a company that is quickly realizing that that is a losing battle. So a few years ago, they had the epiphany to launch their mobile app and to really push hard for their mobile app to be prioritized by their customer base. Instead of just using SiriusXM in your car, you can pay more to have access to the app. Now you can utilize SiriusXM or Pandora wherever you go. And if we're going to be honest, they probably stole that playbook right from Spotify because that's how Spotify does their business. And their whole idea is if people are using SiriusXM through their phones while they're pooping on the toilet or as they're driving or as they're just working from home or at work itself, they develop and gather so much data about that customer that they can deliver a more personalized music and listening experience that they know is going to keep them tuning in longer and longer. And to me, that makes a lot of sense. That's exactly what YouTube and TikTok and Instagram Reels does as well. They try to cater towards you content that you like to watch. And on that note, if a half-naked girl with her boobs spilling out of her shirt pops up on your homepage or feed, you better swipe away. Because the moment you entertain that half-naked girl and you click like or you leave a comment, the algorithm is going to deliver you more half-naked girls to your screen. And we both know that you're gay and you don't want that anyways. But have some respect to your overweight wife and do not look at other women, okay? Jokes aside, with SiriusXM prioritizing their mobile app and pushing that alongside with Pandora and podcasts, at least it shows that the leadership team that's guiding this ship is not that stupid. As a matter of fact, back in 2020, if I scroll up right here, SiriusXM acquired Stitcher, as you can see in the center of your screen, which was one of the most popular podcast platforms that people like to use to listen to exclusive podcast content. And consequently, because SiriusXM bought this company out for I think it was around $325 million, maybe a little less, maybe a little more, they transitioned all of that content from Stitcher onto SiriusXM. I don't even think there's such a thing as Stitcher, the app, anymore. And because they integrated Stitcher into the SiriusXM ecosystem, when you think about it, SiriusXM now provides exclusive talk shows, podcasts, music, live sports commentary, DJs curating the next song live, and they do so much more. SiriusXM turned themselves into a one-stop shop listening experience for the consumer. That's amazing. That makes me bullish as crap about this company. Yes, they are going through a sticky, smelly pickle for the past, 365, maybe 700 days. But the turnaround story, narrative, and prospects for this company, dude, it's endless. But before I get ahead of myself, I do need to disclose this as well, right? When we think about SiriusXM and Pandora, the reason why I made a call out earlier to my international viewers is because their reach is only confined to North America. Yes, they cater specifically towards Americans and a little bit towards the Canadians, which first glance sounds really bad, right? It's like, dude, that's only a limited market. When you consider China, India, South Korea, and the rest of the world, there's so much more potential paying customers. Why only America? And it sounds terrible. However, for me, I don't really see it from that angle. Because I think about it like this. Once they open up the gates, do the negotiations, the trademarks, the copyright, whatever they need to do to open up to the rest of the world and they expand into Europe, Asia, Africa, wherever you live in your tiny little condo because you're divorced, potential growth of their subscriber base moving up from 50 million users on Pandora and 34 million users on SiriusXM to go up to 100 million, 200 million, dude, that probably makes Warren Buffett's nipples very, very hard. That's probably what he's seeing in this company to the point where he owns a third of the freaking company. All that to say, I don't think this company has reached its final form. Because up until this point, by only focusing on North America, they left a lot on the table. It's like wiping your butt only once after pooping. My friend, you still have 2 or 4 more wipes to go. And that's the way that I look at SiriusXM. The growth prospects for this company, endless. But please forgive me. I think I've said too much already. Let me just save these thoughts for the end of the video when I give you my personal take and opinion on the company. But before we go any further, let's take a look at their most recent earnings. It'll paint a picture as to why they have such a messy financial picture on surface level right now. So the expected revenue was around $2.19 billion. Instead, they posted $2.17 billion. So they missed on their revenue. What about the earnings per share? Well, that's where it gets really ugly. The estimated earnings per share was 77 cents a share. However, Instead, they posted negative $8.74 a share. That's a huge miss. So what exactly is going on? What went wrong with SiriusXM in this most recent earnings? Well, they posted a huge, I'm talking about a gigantic, non-cash impairment charge of $3.4 billion because of their restructuring with Liberty Media, which is why their dividend payout ratio was all wonky and their earnings per share was just disgusting. When it comes to publicly traded companies, the balance sheet and income statement can be manipulated beyond belief, especially with accounting and how you process the numbers. So with an impairment charge, what happens is the company records this loss on the income statement. And in effect, it reduces the net income for that period. Think about like when you buy a car. The out the door price is $20,000, and let's say you pay it. So that car is valued at $20,000. As soon as you drive it off the lot, like a mile down the road, its value drops down. Be very exaggerative and say it drops down to $10,000. That's basically what an impairment charge is. It's no longer worth what you paid for. It's no longer $20,000. And that's why I always get my cars used. I don't buy a brand new car. So circling it back to SiriusXM, companies do impairment charges when assets like, investments, equipment, or even brands lose value. And this happens because of, market changes, poor performance, or it just doesn't work out the way they thought it was. So what you see on your screen right now is that Liberty Media transaction painted out. So as of right now, SiriusXM no longer is partners with Liberty Media. They're their own independent company. So their Q3 2024 earnings per share, that's why it looked like such a hot mess on paper. However, what you do have to keep in mind is that right there, non-cash impairment charge, meaning it does not involve actual money leaving the company. It's just an adjustment of value on paper. Remember that car example that I gave? You didn't actually lose $10,000 of physical cash. It's just the value of that asset that you own in that car is just worth 50% less now. That's kind of what happened with the Liberty Media restructuring in SiriusXM. Which is kind of funny because last year, Q3 of 2023, they posted 82 cents that quarter. This quarter was negative $8.74. And that's why it's really important to read between the lines and analyze and look at the details to see what's going on. Because on surface value, you might see that they posted negative $8.74 and just dismiss this company as trash. But once you look at what's really going on, you understand it's not exactly the worst thing in the world. However, the revenue did go down by 4% year over year. The adjusted EBITDA went down by negative 7% as well, so it isn't all rainbows and sunshine either. Free cash flow went down by 64% year over year. Now let's talk about their free cash flow, right? And if you want, you can pause right here and take a look at this slide as well. Positioned to capture near-term and long-term opportunities. But slide 7 is what I want to, yes, right here, slide 7. So as you can see on your screen right now, their capex, which is the capital expenditures, what you have to spend to maintain, to update, to upgrade, to replace your assets, your physical assets, they're doing this right now with their satellites that are flying all over space until about 2026. Then they're going to start pulling back that money, which means since their capex cycle is almost over, just 1.5 more years of doing it, their free cash flow is going to be freed up soon. And again, that's why earlier we saw that their free cash flow was decreased because they were spending that money on software, hardware, and satellite upgrades, maintenance, whatever you want to call it, asset, overhead costs. All that to say, when this free cash flow is back into their pockets, this is a company where in their history and DNA, they utilize that cash left over and dedicate it towards the dividend growth, the dividend payout, and buying back shares. And as of right now, according to their balance sheet for the trailing 12 months, their total debt is about $10.7 billion. So what I hope happens with that extra cash on hand from 2026 and onwards, they focus and prioritize on paying that down first and foremost. And I don't care if they keep the dividend flat. I would rather see the dividend not grow year over year if it means that they can bring down their debt to more manageable levels. And because Warren Buffett has a third of the ownership in the company, I hope that he can articulate that strategy to them as well. Because Warren Buffett plays the long game. When you consider the stock market and Wall Street analysts, they look at companies and specifically SiriusXM for the next quarter, for the next year. But Warren Buffett is looking at this company for the next 3, 5, 8 years from now. I don't know how much longer he's going to live, but he looks at his investments with a long-term lens. And that's why even though the company posted negative earnings per share, he's not sweating. Because Warren Buffett understands what a non-cash impairment charge is. And before we move on to my most favorite part of the video, which is doing the valuation models to figure out the intrinsic value, let's just quickly go over the pros and cons, the bull case versus the bear case for SiriusXM. First, let's start out with the positivity, the optimistic lens. So number one, they have a monopoly with satellites. SiriusXM is the only licensed satellite radio provider based in the US. Yes, the music streaming landscape and modalities are changing constantly, but I still think those satellite assets give them a unique market position with significant barriers to entry for competitors who want to enter into the radio satellite business. And number two is that SiriusXM operates on a subscription-based business model, in which, as we all know, the best companies in the stock market operate their finances in that way for that steady and predictable cash flow in lieu of a one-time payment. And number three is that they have strategic partnerships and car company relationships, meaning SiriusXM is already pre-installed in most automakers' infotainment systems. This gives them access to new car buyers, and it allows them to grow their subscriber count through trial offers. Remember how we talked about earlier for the longest time, that was their strategy in attracting new customers? So basically, they have a monopoly in this regard. And the best part is they're slowly starting to future-proof their business by pushing their mobile app to customers as well, because not everyone drives a car like me. I don't have a car. I just use my bicycle everywhere. So I wouldn't utilize SiriusXM with my car, or I guess non-existent car. And then number four, SiriusXM has exclusive broadcasting deals with some of the most popular personalities that exist on the planet Earth. No, I'm not talking about your ex-wife. And they also have original content that is licensed through SiriusXM, meaning if they play it on a third-party platform, they get a cut or a fee. We're talking about the likes of The Howard Stern Show, Kevin Hart's Laugh Out Loud shows. Kevin Hart has like a whole list of shows that he operates on SiriusXM. And along the line of comedians, they also have the Jeff and Larry's Comedy Roundup, which is the Larry the Cable Guy. I'm not into him, but I know there's a lot of people who do like him. They also have the Marvel's Wastelanders, which is the Marvel Universe Story podcast with Disney. Then they also have an exclusive partnership with the Call Her Daddy podcast. Would I ever listen to a podcast titled Call Her Daddy? Absolutely not. However, based on my limited research, it is the number one and the most popular podcast with the female demographic. And they also have an exclusive contract with Smartlist podcast. It stars Jason Bateman and like two other dudes that I never heard of. So surprisingly, SiriusXM does have exclusive content that would attract a customer to subscribe to be able to listen to that type of stuff. Now, moving along to the other side of the coin, let's talk about the bear case, because there are some concerns that we do need to be mindful of. Number one is, as of right now, I know they're pushing hard for the mobile app, but fact of the matter is, SiriusXM is really dependent on the auto market for subscriber growth. That is, of course, unless their mobile app allows them to get more recognition and expand into international territory. However, I say this is a concern because if there's any downturn in auto sales or changes in consumer behavior, like people like me saying, hey, I don't want to own a car, this could negatively impact their subscriber acquisition because remember, this is how they primarily attract new customers. And then point number two is this. There's growing competition from Spotify, Apple Music, YouTube Music, the list goes on, and they've only been taking market share away from Pandora and SiriusXM. It's something they ought to address fast and aggressively. And number three is the stagnating subscriber growth. I think for the past, 7 years or so, SiriusXM has just been flat. And number four is limited footprint. Unlike their competition, SiriusXM operates exclusively in the US and in US's Canada. This geographic limitation caps all growth potential. And so what I'm thinking is, without international expansion, I keep saying that again and again, but it's true. Their growth story is going to be non-existent unless the US catches up to China or India and becomes a 1 billion person population in the next year or so, which I don't see happening. Unless they expand overseas, their competitors are going to continue to take their market share. And then number 5, this one is icky, but it's worth mentioning. Satellite radio is just unnecessary. It's a technology that's outdated in regards to radio because internet-based streaming is only getting better and better. I remember when I first had internet access on my cell phone back in like 2010 or 2011, it literally took like 3 to 4 minutes just to load a page, let alone try to stream any kind of media content, right? Now, you can stream an entire 3-hour Spotify playlist in your car while just using your mobile data. Those expensive satellites do the same job that a 5G and 4G mobile device can do. So it's kind of like, is the satellite even necessary? And finally, I've been recording for the past 2 hours. My voice is shot, but we made it to my most favorite part of the video. We're going to run some valuation models to figure out what is the intrinsic price for SiriusXM. Like, is it actually undervalued on paper? The first one is going to be the multiples valuation. You know what? I don't even have the time to explain what it is. The multiples valuation is going to be $34 a share. They're currently trading for about $27, $28, depending on when you watch this video. The next one is the DCF model, and that one is going to give us $34 a share as well. And the next one is going to be the DDM model, and that one is going to say $28 a share. And last but not least is the Benny Graham's valuation model. This one says $37 a share, which brings us to the conclusion. Jimmy, you got to hit them with the drum roll. The intrinsic valuation for SiriusXM is going to be $33.75. The Wall Street analysts believe the price target should be $30. So we're on the same page and on the same brain wavelength. So now that I heard everything and I saw everything and I looked at their numbers, I want to figure out what's an acceptable buy price so that I don't overpay for this company. Or just to consider what is a good, attractive buying price. At the current share price of $28 a share and a 10% margin of safety baked in, then the acceptable buy price is $30 a share, which means right now, if I were to pick up shares of SiriusXM, I get a discount of $2.38. And if I were to buy SiriusXM right now at $28, then I would get a 17% margin of safety. But let's go ahead and say, because this company is going through a rough pickle and a speed bump right now, and the revenue is declining, the subscriber count is declining, for me to even consider this company, I need a bigger margin of safety. 30% margin of safety, then the acceptable buy price is $23.63, which I believe that's how much Warren Buffett's average share price is at this point. And now, well, hold on. I guess this is my second most favorite part of the video. This is where I share with you my thoughts and opinions surrounding the company that we just evaluated. Here's what I think. I love what I see on paper. Their finances, well, minus this year, it looks pretty. It looks good. Right now, they have a ton of debt and leverage, but then again, I have to remind myself that predictable subscription-based revenue mitigates the risk associated with their loans. Because I'm telling you right now, if they really wanted to, instead of focusing so much on shareholder return, if they really wanted to, they could stop their dividends right now and pause their buybacks to pay off those loans in a few years because they make so much free cash flow every single year. So when we think about their debt of about like $10 billion and their free cash flow is consistently around $1.5 to $1.6 billion, it's a plausible story. But what I don't love is their story. So I like their finances and their numbers and their gross margins, but what I don't like is the story. I just don't know if I believe in their future, especially with Spotify dominating the music and podcast streaming scene. Everybody uses Spotify. I might be the only guy on planet Earth who does not use or like Spotify. And something else that comes to mind is the fact that if Warren Buffett ever decides to sell out of this company, this stock is going to crash really hard. If he doesn't feel good about a media company, he cuts losses like there's no tomorrow, like with Paramount stock. He doesn't care if he's in the red. He'll just sell out of it. I guess it depends on who you ask, because the fact that he owns a third of the shares outstanding is either a compelling bull case that he believes in the company and he's holding, or it becomes a risky endeavor. He's a long-term investor, so I would like to think that he's holding on, but if SiriusXM does not turn it around and show improvement, there is the real possibility that he could sell out and crash the stock price. Then again, when we think about the company outside of the context of Warren Buffett, SiriusXM is basically a monopoly with their satellites providing music and radio because no other company is utilizing satellites to do that in the US. The bigger question is, can SiriusXM use those satellites for other purposes? That could be a potential catalyst if they can, because right now, they're only using it for radio purposes. Stick with me, let me explain my thought process. What if in the near future, satellite radio, aka XM radio waves, replaces FM and AM radio? Think about it. FM and AM technology is absolutely outdated, inconsistent, and the range is regional depending on where you are. But what if we were to transition from using radio towers, FM and AM, and instead, nationwide and worldwide, we start using Sirius XM satellites that are all over space? Because on one hand, you could absolutely assume that it's only a matter of time before FM and AM radio disappears. And when it does, something needs to take its place. And I feel like that something could be SiriusXM, and they're going to be a huge winner. And before you think to yourself like, dude, who the hell uses radio? Believe it or not, millions of people still do. Not everyone is as tech savvy as you are and utilize, Spotify and YouTube. Whether or not this idea and this plan pans out, who knows? And before I transition from that thought process, I guess on the other side of the argument, it's going to be so expensive for SiriusXM to be able to support that infrastructure of hosting every person's little radio show that used to be on FM and AM all over the world. And then there's only a limited amount of channels and bandwidth available. So who knows if it's even a possibility? I'm not an engineer, but I'm just throwing and spitballing ideas out there. Because what I personally think is, what if we don't use those satellites for radio and music and podcasts at all? Because if you think about it, the space race and commercialization of space is happening right now. The biggest growth opportunities, some people say, are seen in, Starlink, SpaceX, Blue Origin, space tourism, and everything else that's related to space. So what I'm trying to get at is, SiriusXM, as of right now, they own a crap ton of satellites that are physically flying around space at the moment. So maybe in the future, what I'm thinking is, it's their satellites that provide a different kind of service rather than just radio. See, I'm just an idiot that makes YouTube videos in his boxers at home, so I'm not sure what else we could utilize those satellites for, but regardless, it's their arsenal, their portfolio, and the fact that they have an infrastructure of satellites in space that's pretty compelling. I'm not sure what it can be used for, but it's the fact that it's out there in space that's the amazing part. So is it a crazy idea that Starlink or SpaceX were to eventually come out and say, hey, I want to buy out SiriusXM for that satellite footprint? Because I can absolutely see that from happening. All that to say, I think when considering SiriusXM, I think I can see why Warren Buffett went balls deep into this company. Because when you understand Warren Buffett, he doesn't care about hype or trends. But what he does care about are financial fundamentals, good margins, and buying an undervalued company that the market is mispricing. And when you put all of that together, that's SiriusXM. And they also pay a juicy dividend, which Warren Buffett is a huge fan of, even though he's a hypocrite because Berkshire Hathaway does not pay a dividend. And that's because he says, well, we can use the cash left over to grow the business better than just giving you a dividend. Okay, whatever. He's one of those people that's like, do as I say, not as I do. So the business model seems stable. I know it's kind of declining, but for the most part, it's kind of flat. Even with the customer, churn rate, it's not bad. Because when we think about a 1.5 to 2% a year, that's pretty good. I think this is like my 20th time mentioning this, but I think if SiriusXM wants an honest chance and opportunity at the future, especially to become a growth company, they definitely need to expand. They need to provide their service overseas because only catering to the American audience, dude, I think it's a stupid decision. I can see myself investing into this one. I'm not going to say that it's a delicious dividend compounder. If the leadership team continues to just operate in the US, this is a dying company. It's very mature and they can stabilize their margins and be consistent in how much they post, but I don't think they're going to be able to grow. However, if I were to think about it with a bullish lens and they expand overseas, dude, that's a compelling case. Now, the thing is, I wouldn't go all out like Warren Buffett did. Expectations from Wall Street are so low on SiriusXM that if they do something, anything out of the norm and they grow, between you and me, I think this stock's narrative has the ability to change for the better. It can go from being a very mature and outdated and dying business to being that of like Spotify. Now, with that said, I wouldn't buy it at its current price of about $28 a share, and I sure as heck wouldn't buy it when it turns $30. I think for me, this is a company that needs a margin of safety baked in that tells me that this price is absolutely a steal. And for me, I think that's going to be around $24 a share. I think $24 is the way to go, at least for me it is. That's what I think. As always, since you made it to the end of the video, I encourage you, and I suggest, you really should, don't be stupid, man. Do your own research because you might conclude that SiriusXM is a crusty, smelly butthole of a company and disagree with me. And if you do, if you think this is a bad company, you have to let me know. Look out for me and let me know because after doing my research, I went into it kind of like, whatever, I don't think too much of it. But after doing my homework and research, I'm walking away thinking like, dude, I think this is a undervalued company that has the ability to just compound and grow like no other once they leave North America. That's what I took away from it. But if you take away that it's ugly, disgusting, and smelly, please do me a solid and let me know. And if you like this kind of content where the guy goes on a deep dive and looks at the numbers, the data, and the story, then subscribe, man, because no other channel is doing that. They're only looking at the numbers and the finances. With that said, I love you. Stay safe. I'm out. Peace.